Tesla is retracing most of the gains made Friday, the day tens of millions of shares were purchased by index fund managers. Joining us now is S3 Partners managing partner and founder Bob Sloan. Bob, welcome back and thanks for joining. It's been a great year for Tesla shareholders, but those shorts must be pretty glum at the end of this year. We've seen a massive amount of short covering. Talk to us about where we are short position-wise in Tesla relative to the beginning of the year.
Well, we've seen a lot of short covering. We've probably seen 62% of the shorts actually cover year to date, but the stock has gone on such a tear that the value of the shorts remaining is still quite high. I mean, it's $35+ billion. So even though 62% of the shorts covered, the value remaining remains very high.
When throughout the year did we see frenzied short covering, let's put it that way? Were there points throughout the year where shorts were desperate to cover because it looked like the price was just going to go ever higher?
Yeah, the last time we were on in August, our analyst, Ihor Dusanowski, who is, I think, the real source of information for the marketplace, called it right. He said this is the mother of all short squeezes, and here we are.
Yeah, exactly. But there were clusters of shorts around certain places, which obviously took the outstanding shorts down from 130 billion shares to 50, and now, as you say, you know, maybe 30-something thousand. But in comparison to the next three biggest companies with the most shorts outstanding, it's still more than all three combined, Bob. What do you do if you're a short seller of Tesla now? Do you continue to wait?
Well, what we've seen actually in the last month is something interesting. Even though this has probably been the single largest negative bet for short sellers, meaning they've lost the most money ever, we still see people initiating new shorts as the S&P inclusion happens. So, you know, there is still a school of thought that this is a bubble that Elon Musk created, and we're going to short that bubble. Eventually, things mean revert. The company has to make money other than credits, and you still see people willing to play that bet.
How do they manage to hold on? I mean, are there margin calls happening out there? Are there people losing their shirts? Is there a point at which you were just stopped out?
Well, I don't know if it stopped out because, you know, playing in the derivative market is very hard because the volatility is so extreme. It makes the premiums very expensive. So what's happened is that you had a lot of short covering, but the stock has gone up so much, it makes the value of the remaining shorts very high. So for example, if, you know, when the stock was, let's say, $350 pre-split, and you had a 1% position, the stock's now up 7 times. So now you have a 7% position. So you're covering all the way up. And even with that action, there's still $30+ billion worth of shorts in the marketplace. So mind you, that is a gross number, meaning that is we understand that there's convertibles and there's other things associated with the capital structure of the company, but we leave that to the professionals to figure out what's the hedging ratios and things like that so that they can come up with an accurate number. But $35 billion is still outstanding.
Who are these people with, you know, backbones of steel that can actually wait this out, Bob? I remember, you know, Jim Chanos speaking with our Scarlet Fu earlier in the year and saying, look, I understand it, but I'm not going there.
Yeah, so our company never puts a name next to a transaction. You know, it's never who, always what. We measure the total value of what's out there, and that's what makes our data really valuable. So for example, let's talk about the S&P for a second and the inclusion of Tesla. You know, one of the interesting things that we found out in some of our research is that the actual weighting in the S&P actually has to do with the amount of float that's in the company. So it's not just the market cap of the company, it's the market cap minus the float. Well, what happens if the float is wrong? It means the weighting is wrong. And it also means that there's more liquidity out there in these stocks that are being shorted than you might think. And it also explains some of the drivers behind performance that is really not explainable given the information that's available out there. And that's why data companies like us actually thrive, because our data is actually helping people understand when the information that everyone consumes and everyone doesn't question is actually can be improved. So it's a really interesting point that, there's a big difference between data and information.
Bob, if I could just get your thoughts on the SPAC explosion. We see this every couple of years or every couple of decades, I suppose, to be more accurate. Anything concerning you about this particular one?
Well, it's too early to tell. I mean, there's an incredible amount of money being raised for taking, companies public. We have our eye on that. It's something we've been asked about a lot. It's still very early days.